Suffice to say that the major bullion banks are being unabashedly bullish. And if they're looking to pull the rug on you, well, they're going to have to pull the rug on their bigger clients first. I don't think I think we're looking at a cultural change in the bullion banks. They may not be bullish all the time. They may not be long all the time, but they have clients who want to have gold on their books. And as we'll see in the report, the client business is what drives the bank business.
Gold prices surged past the $2,400 mark on Wednesday before slightly retracing to the $2,388 range. The Golden Dollar Index exhibits notable strength on the charts, yielding substantial profits for investors throughout 2024. This upward trend in the precious metal is further strengthened by escalating tensions in the Iran-Israel conflict, driving significant buying pressure. In a recent report, leading global bank Citigroup predicts that gold prices will skyrocket to $3,000 per ounce within 18 months. This forecast reflects a significant bullish sentiment prevailing among major bullion banks, exemplified by Citibank's stance. Market trader VinceLanci interprets this as a cultural shift within these institutions, signaling a more positive outlook on gold. Despite consolidation around $2,400 per ounce, the gold market remains resilient amid stagnation in the U.S. housing market, as indicated by the latest data from the National Association of Realtors. Lanci emphasizes that central banks increasingly recognize clients' demand to include gold in their investment portfolios. Akash Doshi, Citi North America head of commodities research, echoes this sentiment in an interview, stating, "We believe the risk skew favors further upside for gold." He anticipates that financial macro factors will align with solid physical demand, supporting the gold market. Doshi suggests that the risk-reward ratio leans towards higher gold prices, especially as hawkish monetary policy measures reach their peak. Additionally, he highlights the Federal Reserve's inclination to maintain 10-year Treasury yields below or at 5%, implying continued support for gold in the prevailing economic environment. Join us as we explore the valuable insights provided by VinceLanci. Don't miss out on our latest updates, subscribe to our channel, and activate notifications. Thank you for tuning in.
Citibank put out an update of a report yesterday, and they made sure that the news media got it, I should say. And CNBC talked about it, and the $3,000 was in the headline. We gave you that as well, and we're not diminishing that headline. That's actually an appropriate headline. We got the update yesterday, and then we're going to share that with premium subscribers and give you a little bit of a preview of it here. Okay, the bank upgrades its baseline gold price forecasts to bull case scenario from the 2Q commodities outlook and Wildcard's 2024 report. What does that mean? The second quarter 2023-24 commodities outlook report, which we have here, they updated their bull case. They raised their price targets. Wildcard's 2024 report, that's something that Citibank does proprietarily. They have a geopolitical macro report that we don't see that report. We see the updates on it once in a while. And that report gives if this happens, then we could have a spike up to that or a drop down to that. And that's where their 3,000 price wildcard spike was last year. Gold's going to go up, but if this, and this happen, you could have a spike to 3,000. And, we covered that as well. However, this month, they've kind of moved that wild card of the wild card 3,000 and into the commodities outlook update itself. So what you're kind of seeing is a gradual raising of the target in steps or fits and starts. Anyway, next sentence. For 2024 estimate, this means a 6.8% bump to $23.50 per ounce. For 2025, this means an admittedly massive 40% upward revision to $28.75. Now we'll talk about the 3,000 and 2,400 and what that means in the context of the rest of the report. Suffice to say that the major bullion banks are being unabashedly bullish. If they're looking to pull the rug on you, well, they're going to have to pull the rug on their bigger clients first. I think we're looking at a cultural change in the bullion banks. They may not be bullish all the time. They may not be long all the time, but they have clients who want to have gold on their books. And as we'll see in the report, the client business is what drives the bank business.
Gold prices have bounced back from recent dips, with the precious metal now trading around $2,370 per troy ounce during Thursday's Asian session. Amid escalating geopolitical tensions in the Middle East, traders are seeking refuge in gold's safe haven appeal. VinceLanci emphasizes a pivotal moment for gold as it approaches a significant trend line on the hourly chart. Buyers are advised to exercise caution until gold breaks above this line, as a breach below could signal short-term bearishness. Furthermore, Federal Reserve Chair Jerome Powell's recent remarks on limited inflation progress hint at a potentially hawkish stance, which could negatively impact gold prices due to higher interest rate expectations. Lanci notes that silver follows a similar trend to gold, albeit with a less pronounced slope, making it potentially more susceptible to downward pressure. Bears might target silver to exert downward pressure on precious metal prices. The silver price opened at $28.62 per ounce, reflecting a 0.51% increase from the previous day and a significant 19.6% increase since the beginning of the year. Let's return to the interview.
Moving on to price action. Beach ball time for gold. I said that yesterday. Yesterday I said silver's leading the pack, but it's not so obvious now. I might not be right about that. Looking at a couple charts, I'm rethinking that. I think silver will lead the pack when we go up, but it will chop around. It's a hard call. I'm not sure. Miners, we already talked about those. Oil touch and go. Bitcoin still looks weak. Stocks, there's a problem. VIX manipulation. Wall Street gains at Main Street's expense. Offshoring services, onshoring of manufacturing. So as we build manufacturing here, our service companies are going to go overseas. There's a rotation industry-wise. Okay, out with the old. Commercial real estate's just going to continue dying. Wall Street gains at Main Street's expense. When you hear bank earnings are doing really well, that's because Wall Street's gaining. And when you hear your buddy down the street is getting laid off from Microsoft because they're going overseas, that's because it's at Main Street's expense. There's a lot more on that as well. We'll do data and we'll just take a quick look at the charts. Okay, data today is the beige book. Important, little understood these days and not digested immediately, so you shouldn't expect a knee-jerk reaction on it. However, the Silver Institute report is supposed to be out today, and people are looking for that to drive silver higher. That's already in the market. I mean, it could, don't get me wrong, but these things don't stay private. If it goes down in the market, if it comes down in the market rallies, that's great. And in premium, which stay with me, we're going to talk about that in a second. We're going to talk about the Citibank report. Okay, gold. Here's an hourly chart on gold. See the hourly chart on gold? There's your trend line lower. This line here, I'll tell you why I drew it. This is where technical analysis comes from. The market goes up, gold. This is the first hour that it makes a decision it wants to try it. And of course, it finds more selling up here. But the point is, this is the area it pauses, looks left, looks right, and makes a decision. So this is my area now, okay? Until we get above that, you're not a buyer. If you're already long, you're long. But until we get above that, you're not a buyer. If we get below this, you should be short-term bearish. But, this buying down here, no way, man. I mean, if it goes down here again, maybe it won't hold. But I have a feeling that, this line isn't crucial, but it is someone who's buying it. So there's buying in here, very algorithmic type buying, and there's probably fundamental buying down here. Moving to silver, similar structure, but not as steep on the line, right? Okay, so same idea here, but if I were a bear and I wanted to crack gold, I'd crack silver because the line's not as steep, the market's not as algo driven, and doesn't have far to go to test that area again.
Silver prices have experienced a remarkable surge in the last quarter of the previous year and the early months of this year, maintaining their robust momentum as we enter the second quarter. In just the initial 2 weeks of this quarter alone, silver has soared by over 15%, signaling a fiery beginning to the period. With silver consistently achieving significant gains in recent quarters, do you foresee this momentum enduring throughout the year? Share your insights in the comments section below. If you found the video insightful, consider joining our community by subscribing to our channel and activating notifications using the bell icon. Thank you for being a valued member of our community.